Thanks, Steve. Good morning, everyone. Bit of an overstatement there, Steve, but we'll do our best. It's always good to talk about my pet subject, which is real estate, and something I've been in for the last half a century or thereabouts. So, and it still keeps on going, which is terrific. I think one of the interesting things about property, which gets a lot of attention, a lot of column inches in papers and a lot of stuff on socials these days and everything else, who's bought what and who's paid what for their house and everything else. It's such a fundamental industry, which is why I think I like it, because I'm a pretty average bloke and I got my feet on the ground. I'm not very smart, so I sort of staggered into real estate about 50 odd years ago and just really loved it, because it's such a basic thing. We all need real estate. We're sitting here in a room that's got an economic return. We go home to a house, it's got a roof on, it's got an economic return. We're in factories, we're in shopping centres, we're in hotels like this one, and everything has a yield attached to it, a return, it has a life expectancy, it depreciates, it needs to be redone, and it's what we all have to use. And we're very lucky to be in a country like Australia, because we're not confronted with horrible things that happen in other parts of the world, where there's massive sovereign risk, there's risks to life as well, as we know, tragically at this time. And we live in a country that's got very good laws, great ability to own. It doesn't exist in a lot of places in the world where you can actually own something like real estate and keep it and trade it and do all sorts of things. So I'm just going to give you a quick run through. I've only got a few minutes, I understand. The thematics, and incidentally, I'm on the board of Charter Hall, which bought my last business, and I'm the chair of the investment committee. So a lot of this comes from, it's our house view, as well as Leftfield Capital, which is my own private debt business that we put together 5 odd years ago, and that's something we attract capital from people like yourselves to invest alongside us. So it's a dual thing. So the thematics, the outlook has shifted dramatically in the last few years. If we go back to 2008 and 9, when the GFC hit, we've seen interest rates come off basically down to zero. Real estate is heavily correlated to the bond rate, and when interest rates are high, then we lose value. When interest rates are very low, we saw this phenomenon right over the last 10, 15 years, where we've had a steady increment in value caused by capitalisation rates, yields coming down to lows that I've never witnessed in my life, and most people haven't. So prime yields for industrial, for instance, that used to be in the 8s, got down to 3.5%. Commercial office buildings that were in the mid-5s to 6% range for literally decades got down to about 4, sometimes a little less. Retail, which has always been at the top of the list in terms of performance, suffered from a number of issues over the last decade, and particularly around COVID, which spooked a lot of things, and the change to e-tailing as well as retailing. But we've seen with the end of the interest rate cycle, and interest rates stabilising and now starting to come back a little bit, we're starting to see the bottoming out of the commercial real estate cycle, which probably bottomed out was in the last 6 months. And that's been good, so that we've shifted from pessimistic to the more favourable as global central banks have started cutting rates. We remain a safe haven for those people in the world for the reasons I've just mentioned. Sovereign wealth funds like Australia and the Asia-Pac regions, we're number 1 in terms of where they want to put their money. Japan's number 2. There's abundance of capital for both equity, that's property ownership, as well as the debt side. All institutions have an excess of capital waiting on the sidelines for the right deployment into real estate investments. That's from around the world. A couple of little exceptions. They're very skittish about the Victoria at the moment with Melbourne because of the issues with the government there and the taxes that they're burdening property owners with. There is pretty much a chronic undersupply of all forms of real estate investment, including residential, across Australia at this time. Why is that so? Well, we just stopped building things. And with the situation with COVID in particular, which caused a lot of factors to cause a lack of ability to build, we find ourselves with rapid rapid growth in population that we're well short on just about every metric. The transaction activity is getting stronger. A couple of years ago, at the height of what I'll call the real estate recession, particularly in the commercial space, there weren't any transactions. So it's very hard to judge what the value of an asset is if nobody's actually putting offers on the table or accepting offers on the table. But we've now seen transactions starting to kick in, both at the prime end of the market and right through across the board. Artificial intelligence as a sideline is a really interesting addition to the real estate markets in a lot of ways. We're all using it now. Even I got onto ChatGPT the other day and pressed a few buttons. My wife actually sent me a nice poem for an anniversary that I'd forgotten just recently, and I thought, my God, that's an amazing. Kerry's not bad at writing, but this was phenomenal. And I found one of my sons had been home from Europe, and he taught her how to do ChatGPT. So I got this rather nice little thing. But the interesting thing with all this is the need for storage of information, and data centres, just as a side, have been in the public eye just recently with a recent float, which probably didn't go as well as they would have liked, and there's a couple of reasons for that. But data centre growth, you might have seen Goodman going heavily into that, and just the other day raising another $4 billion to support their push into this for their industrial land. It won't be huge in Australia. It's already quite large, but it just is huge in the US and Europe and other parts of the world. The need for storage, and interesting enough, the need for power for those storage. There's a data centre just out here at Mascot, which is owned by a large US REIT that specialises in data centres. It uses the equivalent of 220,000 households of power use per day. And that's just one lot of centres, and there's myriads of those now popping up all around the country and indeed the world. So we talk about energy crises, we talk about converting to renewables, and yet the need for power is just on a curve that's very, very steep. The preference on the institutional market for what the survey, which is done every year, this is 24, so pretty current, on where the institutions are looking to invest, and I guess we as individuals tend to follow that either by investing through a lot of institutions and or our own investment, follow, I guess, where the market's going. Residential's number one by far. It's a little different in Australia. We've got a thing called build to rent, you might have been observing, which is, in my opinion, a very small part of the market. It has a very small need in this country. We're totally different to the US and the Europe, the way we house people and the structures around those. You have multifamily being what BTR is called in the US, and that's been around for 50 years. It's mainly to house workers. Big factories get established. They want to hire 10,000 people. They want to house them somewhere. The municipalities compete for those workers and those plants, et cetera, et cetera. So it's a very efficient system over there. Whereas here it's very expensive to build. It's vertical as opposed to horizontal. But nevertheless, institutions are very focused on the residential, and there's a myriad of different things, from build to rent, student accommodation, multifamily of all sorts, boarding houses, NDIS, etc., a range of things. INL, which is industrial and logistics, is next on the list, and then life sciences, data centres and healthcare, and student housing. Conference I went to a couple of years ago in Europe, EDS, beds, sheds, and EDS, beds, sheds, and meds. So you had medical, student accommodation, sheds being industrial and logistics. That's all that people were talking about. They didn't want to talk about retail. That was never going to recover. They were never going to talk about office. That had gone. Everyone's working from home. And they certainly weren't talking about hotels. Just a couple of insights. The office market has recovered significantly here in usage. So we went through COVID. We all worked remotely. We all worked from home. And in most cases, and you'll pick this up in the press, people are returning to work. Why are they returning to work? It's very hard to run a business with people working remotely unless they're specific types of businesses. IT people tend to do it better than most. Why? They've got the technology and that's what they do. They communicate through a machine. But most businesses require an interaction between the leaders of the business and the people working in those businesses and the training of those people and the interaction with the clients, etc., etc. So with the exception of Victoria, all states are pretty much now, I'd say 80 to 90% return to the office, and you'll see more and more companies insisting. First of all, it was 3 days a week, and now it's sort of 5 days a week. We expect you to be at the office. That's what we pay you to do. We want you to be there. We want you to interact with people. Productivity started to plunge a couple of years ago because of that. The public sector is the one that doesn't like going back to work. I have a reason for that. They don't work anyway, so why bother? I reckon if we just sent the paychecks home to them, we'd save a lot on public transport. We wouldn't lose any productivity because I'm not kidding. They do not do a hell of a lot, most of them. And they just employ more. They put more and more on the payroll. You saw in Queensland, I think it was another 50,000 workers just put on, with Palaszczuk actually saying, well, it's better than paying them a dole, they may as well turn up here. And that was a statement she made. So all that is coming about. And the interesting thing in the office market, there's been a move really to upscale yourself in terms of what the tenant requires and what their people require in accommodation. End of trip facilities, bathrooms, where to store your bikes, all those sorts of things, breakout areas, a different way of working, if you will, and that's always been the case, that it does evolve. We've moved from a very tight, up to about 8 square metres per person. It's now up to probably about 12, so people are needing more space. They want more area to be around. COVID taught us that we shouldn't be too up close and personal. And they're insisting that the quality of the buildings, the energy, all the ESG components are there. ESG, as I mentioned, remains core. They're insisting on that, and technologically integrated buildings are absolutely in demand. The secondary market, which, if you look at the graphs, you've got a take-up in prime and A-grade space, and B and C-grade space is falling away. That space will be recycled over the next decade. Most of those buildings won't be torn down. The embedded carbon in these buildings is huge. It's not regulated yet in Australia, but it is in other parts of the world. We actually can't tear buildings down because of the actual carbon that you're putting back into the atmosphere effectively. So that. So you're going to repurpose these buildings. Most of it won't be for residential because office buildings and resi aren't normally compatible. There will be some, but they will be repurposed. They will set another level of accommodation, and that will occur over the next decade. And some of the buying in that area is not too bad. Industrial and logistics, which I mentioned, structural drivers of demand has been huge. There's a whole bunch of factors around that, from technological advances, the big warehousing now, all the Amazons of this world, Coles, Woolworths, Audi, you name it. The people that are using large space areas are requiring very sophisticated equipment in their warehousing. There's very few people working in these buildings. It's all automated. So somebody's in a control room, machines are running around. It's quite amazing to see. And that bifurcation is once again to that high-end new standards is gathering momentum. Interesting enough, the yields on industrial just a few years ago got down to net yields of 3.4, 3.5%, coming from a high, which I mentioned earlier, of 10 years ago, about 8%, and it was down around 5, 6. and that meant the values went up dramatically. Where office values have fallen 30%, industrial hasn't fallen that by that extent. It's only been a few percent because we've had huge rent growth, because there's a huge shortage of the suitable accommodation. We have the lowest vacancy and highest rental growth globally in this sector, and there's insufficient zoned land in this area. Once again, the biggest issues we've got in this country in terms of being able to develop enough housing, enough industrial, enough, not so much office, but retail, is the lack of zoned land in the right areas. And believe it or not, this still exists today in a land of 7 million square kilometres. You think they'd be able to get some organised land available, but believe me, it's in short supply. Retail, shopping centres, both super regionals, which have suffered quite a lot in the last decade. The Westfields of this world, which is run by Scentre Group, Vicinity, the super regionals have suffered. Where they used to have yields of around 5%, they blew out to 6.5%, 7%. A lot of vacancy occurring in those buildings as people moved more, as treating them like showrooms where you might have gone and looked there, but you order online. So what has really, and where we've played a lot, is in the convenience retail. That's going to your local supermarket. You might have 1, 2 or 3 or 4 trips a week, or some cases more, because you just go buy what you want today and move on. And that has been a very steady performer over this time. The yields were in the 6 to 7% range. They're still in the 6 to 7% range. There's a lot of demand for space. There's a lack of zone space, and there's a lack of development at the moment for a couple of reasons. Coles and Woolies in particular have got very gun shy because of the attack from the ACCC in particular, and they've been diverted, their attention's been diverted elsewhere. And the cost of construction has been very high, which has caused a slowdown in availability of product. Population growth, which we keep on hearing has to slow down. I don't think it'll slow down much, and I don't think it'll slow down for a very long period. We've always been a big net intake of people from the rest of the world the last few hundred years, and I can't see that slowing down. It's a moment in time. It's been caused, I guess, by COVID, and then the great influx of people coming back. Because of a shortage of housing, there's been a clamour that we've got to stop immigration. That's not going to solve the problem at all. We have a huge problem with suitably qualified labour, which is causing massive strains in just about every industry that I'm aware of. So that means that people need retailing. And yes, you do some online. It's about 13-14% of sales are online. It could even grow to 20%, may even go a bit higher in time, but you'll still see a need for convenience retail in all its forms, including normal shopping centres, normally anchored by Coles, Woolies, Aldi, etc. And more further convenience with service stations and the like. The living sector, that's residential in all its forms. The federal government has said we want to build 1.2 million homes over the next 5 years. That's absolutely impossible to do, incidentally. We don't have the labour, we don't have the skills there to do that, we don't have the infrastructure to do it. And at the moment, with the amount of infrastructure on government purse, that's our money going in infrastructure, about $700 billion around Australia at the moment, there's a chronic shortage of skilled labour who are being soaked up by that in particular, because they're getting higher wages, and they're taking advantage of that. But there's very low vacancy. Once again, particularly in this state, it's interesting. The Feds say we're going to throw all this money at this problem, and we're going to get this all out the door. The biggest issue is they don't control planning. The local government controls planning, and the state has an overlay, and until that gets sorted out and the three areas of government start working together, we will not solve that problem. It's been around for a hell of a long time. I've been hearing about shortages of accommodation in various parts of Australia all my working life. It'll never be properly solved, but these days, with the planning problems we have and the delays in getting things approved, to get a development approval for a stock standard house in most councils in New South Wales, in Sydney in particular, takes over a year. And this house is going on a 450 square metre block, or a bit larger or a bit smaller. It's bog standard, it's what everyone's got, and yet they will delay you by up to a year. That's at least another 5 to 7% in cost that you're going to wear because of that. If you've got a complying development certificate, that means it sort of fits into a box and you can get a certifier to sign off. That used to be 4 to 6 weeks. It's now about 6 months. So once again, you just simple things. Just add on another 3 to 5% on your cost, because these things go up in cost every year, a bit higher than inflation. That's the way it's worked. So we've got a chronic problem there. The opportunities are, of course, if you can put your hands on land, if you can put your hands on good, well-located residential, you're probably going to do pretty well, particularly in a town like Sydney, where over my journey it's gone up in growth about 6 to 8% per annum. That's changed a little bit now because a lot of apartments are probably a little less than that, but once again, where it's located, what it offers, we'll either keep it at the higher level, which is up towards the 8, or the lower level, which is down around 4. So, in conclusion, we are a safe haven for the rest of the world. That means that the institutional market loves us. That means that these major assets that we see as soon as we walk under George Street are well bid for. Charter Hall just sold a building that I'm a tenant of, actually, at 333 George Street, just before Christmas, at a yield of about 5.5%, $400 million. That went to a German fund that has been investing in Australia for the last 30 or 40 years. The real estate fundamentals are very sound indeed, not without issues. Debt is hard to get, bank debt's even harder to get. Building costs are going up, all those things, all those winds blowing against you, but the fundamentals are good. We don't have an oversupplied market. What that means is, in time, this will get sorted out and there'll be sound returns coming out of real estate. They're not boom conditions, I hope, certainly not. I hate booms. But they're very steady conditions that are going to give us a good underlying runway to get good sound returns from your property, be it equity or debt. As I mentioned, Leftfield, we specialise in the small end of the market, up to $20 million. We like that because it's not great big towers with huge risk. We back land, we back construction, we back residential, industrial, childcare centres, and any good commercial activity that we think we're happy to have our money invested in and our investors alongside us. Thank you very much.